As far as analysis is concerned, you probably know that market structure is key to understand where the big players are buying and selling from. But there is something else that goes beyond that understanding, and is that the main problem institutions, banks, hedge funds have is the lack of liquidity, which doesn't allow them to open and close trades wherever they want.
It's a sale, guys. Ha!
First, let's travel to the smart money headquarters and imagine how their orders grid look like. They long and short literally from everywhere, and the sum of all the transactions must give a positive result. This is when mitigation comes into play. What is mitigation? In simple words, is the action of closing trades that are in drawdown to cut the loss, or to prevent these trades to be in drawdown in the future. Let's take a look at this example. We know that price already moved lower. The most common question people ask is why don't they just close the longs before pushing lower? Why keeping longs down here? If they bought here to induce buyers on this last leg up before selling from this point, why don't they just close the longs up here, right? Before pushing lower? Well, the thing is that they want to get in shorts at the best possible price. That means that if they use the liquidity that was sitting above these highs to close the longs without entering any shorts, why would they open a long in the first place? It doesn't make any sense. For this to be clearer, let's use some numbers. Let's say that they open 10 million longs here and they open 20 million shorts. When price comes back to this level where they had previously longed from, you can see there is a wick. In this wick, what they're essentially doing is closing these longs before moving lower. Now let's take a look at an example where the mitigation is used to prevent the drawdown in the first place. In this example, we already know what happens. Price goes up here and then continues going lower. But what is essentially happening in terms of orders? Smart money is shorting from this level and shorting from this level. At the same time is longing from here and longing from here. The problem is that they want to keep on moving lower. And if they do so, these long orders will be in a drawdown. So what they do is they close the longs before moving forward. How are they able to close the longs? Well, as you can see, in this case, we have equal highs. And the equal highs are essentially inducing sellers in the market who see these levels as a resistance level. So when price breaks out above this resistance, everyone is going to be buying. And when everyone is buying, smart money is shorting, closing the longs. If we press forward, when price did this wick here, all the buyers were stepping in and smart money was using that to close the longs before moving lower. So now these longs are not longer in the market, they were closed in profits, and now the shorts that were briefly in a drawdown when price was up here now are in profits. And the mitigation not only happens with continuations, but also with reversals. In this example, assuming smart money bought from here and short from here, if instead of going lower, they want to keep on moving higher, they first need to close the short in profits. To close the short, they need to long, and to long, they need someone to be shorting. It's a little bit tricky, but that sell side liquidity will be found at least on the previous higher low. As you can see, we have an uptrend here. This is the previous higher low. So price could potentially go underneath this level to trigger the sell stops. By triggering the sell stops, they are now longing by closing these shorts. So once they already close the short, they can keep on pushing higher because these shorts won't be in drawdown when price continues in the opposite direction. Now I'll teach you objective rules to properly identify these levels. And in the last part of this video, we will see how can we use this in our advantage to increase the win ratio, to avoid taking bad trades. If you have been enjoying the video so far, I would really appreciate if you like it. It's a simple action that helps me keep on producing these videos. And if you are interested on learning my full strategy, check the link in the description where I have my full mentorship. So we need an unmitigated level that could potentially be mitigated, where we would anticipate this process of mitigation. First, it needs to be any structural point. And a structural point is basically a swing point that created a lower high and a lower low, or a higher low and a higher high in the case of an uptrend. The main point of interest to me is just the last leg on 1 degree of structure lower. Let's say that this red one has inside of it a lower time frame uptrend in black. The last leg up in this uptrend was this one before price pushed lower. So this is my main point of interest. And the third condition is that it must have left an imbalance behind. For those who don't know what an imbalance is, when there is a gap between wicks of at least 3 candles. So if we look at this example on this move down, there is a gap of unfilled wicks between these candles. This is an imbalance and it represents aggressive sellers that entered at market execution. Once we have these conditions, we can say that this level is an unmitigated level. Now the same happens on lower time frames. If we have a lower time frame uptrend here and we also have an imbalance, we could say that this is an unmitigated level where price could react from. And remember that all of this is in terms of probability. By no means I'm saying that every time this pattern presents itself, it will produce a retracement, but it could very likely produce a retracement. You'll be open-minded enough in order to anticipate every possible scenario according to your analysis when price is hitting one of these levels. Now let's check in which scenarios we can use this information in our advantage. Now let's talk about the 3 ways on how we can apply this to our strategy. Let's say that we are on an uptrend, price making higher highs and higher lows. So your higher time frame bias is that price will keep on pushing higher. Now let's say that there is an unmitigated level right here, and this unmitigated level is your point of interest to continuing higher. Even though you have a bullish bias, this can change due to the reaction and response that might happen after we come from an unmitigated level. Now that we understand the logic behind it, let's say that we have a lower time frame downtrend going towards the unmitigated level. Now when price starts pushing higher, we have a reaction. Now the trend is bullish one more time. But what if instead of continuing the uptrend, we have a change of character and price starts building a distribution? So why would they induce buyers by breaking higher and producing a support level? Because they want to keep on selling. And if they are coming from an unmitigated level and they have already grabbed the liquidity sitting above the previous highs, it means that this level now is a target for the price. And we could expect price to, instead of continue the up move, reverse and push lower again. Now, this doesn't mean that your overall bias of pushing higher is wrong. This might be just another liquidity grab to then continuing higher. Now let's take a look at a real example. A couple of weeks ago, we were analyzing USD CAD on the live session. We were looking at the 15-second chart and I had these 2 different biases for USD CAD. So I was waiting for a proper opportunity to get into shorts. As you will see here, I took a couple of entries. I was following the price action very closely and well, it ended up being a very good trade and they both hit TP. But now the important thing here is what happened in that tiny range. As you can observe, there is an uptrend. Price was making higher highs, higher lows, higher highs. The previous higher low was this one. And there is a beautiful unmitigated level. All of this was a level that was left with an imbalance behind. So I used this same rule. I waited for a reaction, price pushed higher, and it gave me a change of character and a distribution. So why would price react from an unmitigated level and instead of continue the uptrend pushing higher, it distributes right after taking out the liquidity above the last high? It's because in the end, price wanted to keep on pushing lower. As soon as I had a second confirmation, after the break of market structure, I took this trade and this other trade following the trend. We can also use unmitigated levels to anticipate a liquidity grab or stop hunt before breaking that unmitigated level. In this example, we have a bullish uptrend, the red one, and then we have a downtrend on black, a lower degree of structure that now is on an uptrend again. So you would normally expect price to continue pushing higher since the higher time frame is bullish, right? But now let's say that there is an uptrend inside of black of a lower degree and there is an unmitigated level here. So if smart money has shorts open here, but they want to keep on moving higher, before moving higher, they could mitigate it by grabbing the liquidity below at least the previous higher low, so they can trigger the sell stops, use the sell stops to long by closing the shorts, and then after they finish closing the short, pushing higher again. So in that way, if you are looking for a long and price is coming from an unmitigated level, you know that this last higher low is likely going to be taken as liquidity instead of being respected. due to this process of mitigation. Let's take a look at the real example of how to apply this process. In this chart for EURUSD, you can see the price was on an uptrend and then turned into a downtrend. But every time price hits an unmitigated level, they take care of the longs. Basically, they close the longs before continuing going lower and breaking that level. Each one of these boxes represents an unmitigated level, and if we go one by one, price touches the first unmitigated level, it produces a higher high. But this higher high is not an ordinary higher high, it is a distribution. Then the second unmitigated level, price touches it, grabs liquidity one more time of all highs, and then proceeds to break it. The third unmitigated level, price touches it. Not only we have equal highs, but all of these represent aggressive sellers because we have an imbalance. Grabs the liquidity and then breaks through it. And then here we have another unmitigated level. Price, as soon as it touches it, it goes back up, grabs internal liquidity above the highs before it keeps on moving lower. And this is happening over and over and over again. So you can use it to anticipate when these moves are going to happen. For instance, if you were trying to catch a short from any of these levels, you would prevent yourself from taking shorts where the point of interest, the high, could be used as liquidity in order to mitigate an unmitigated level. The same for if you wanted to look for a short here, you wouldn't look for a short at this point. Even though it's the last lower high, since price is coming from a mitigated level, these highs could be used to mitigate it. The same for these highs. What you need to do is wait for price to give you the direction, a confirmation to only then take the short. Here you can see there is another example of reaction and response. This is an unmitigated level, price reacted from it, produced a distribution as response, and then kept on moving lower. So you could have taken a short after this distribution was completed. We can use our understanding of unmitigated levels and combine it with the liquidity story that we are seeing in the market to have a more accurate analysis. In this example, we have a higher time frame downtrend in black and a lower time frame uptrend in red. Now, how to know if price will keep on pushing higher and breaking the black structure, or it will respect the black structure and keep on moving lower? In this example, we have sell stops below the equal lows and we have buy stops above the equal highs. And let's say we have an unmitigated bullish level right here and an unmitigated bearish level right here. And let's say that price first goes higher, triggering the buy stops and inducing buyers. Smart money now has a chance of mitigating this bearish level by pushing lower, because not only we have equal lows where there are willing sellers, but also there are new added stop losses from the buyers who are entering at this quote-unquote resistance level. So when price goes lower, if this bullish unmitigated level is respected, we can anticipate a continuation higher to break the bearish point of interest. Whereas if we have the opposite example, if price goes lower first, they are inducing sellers. These new sellers are placing more stop losses above the equal highs. We also have the buy stops from other willing buyers because they see this as a resistance. So if price starts pushing higher from here, and if this level is respected, you can anticipate this bullish point of interest to be broken and potentially continuing the downtrend. Now let's take a look at a real example. As you can tell from this example, we have a couple of bearish unmitigated levels at the top and an unmitigated bullish level at the bottom. In the middle, we have a weird looking consolidation where the liquidity is being built on the sell side by producing a trend line and on the buy side by producing a trend line as well. Price right now is breaking higher. Now it breaks lower. By breaking this bullish trend line, they have induced sellers, and these new sellers will be placing a stop loss above these quote-unquote support levels. At the same time, price is coming from creating another equal low. That means that there are some buyers that will see this as a support if price was to break higher. If we continue watching, price indeed makes a wick, breaking all the structures, inducing buyers now. The sellers are out of the market, so now the only pending liquidity is at the bottom, at the equal lows. And what a coincidence, we have an unmitigated level. So under these conditions, we can anticipate that if price comes back to this unmitigated level, it could potentially resume going higher, going after this liquidity now, above this now mitigated level right here. We are approaching this level, and look what happens. We have liquidity on the sell side and liquidity on the buy side. The only difference is that on the buy side we already have an inducement of buyers, so now the liquidity is only pending at the sell side. And not only that, we also have the added equal lows to the left. That means that price, if it breaks lower, they will be inducing a tremendous amount of sellers into the market. So we could attempt to take a long from here if we wanted to.